Hey everyone, I'm Michael. Before we get into anything else, I want to hit you with something that, if you really let it sink in, can totally change your financial future. Here it is. Out of the world's richest people, 75% are entrepreneurs, 15% are investors, 7% inherited their wealth, and 3% are athletes, entertainers, or artists. You know how many are just employees? None. Not a single one. 0%. Let that sit for a second. Nobody at the top got there by clocking in and out for a paycheck. Not one. So if you want to manage your money like the top 1%, you have to look at what those four groups all have in common. Let's break it down. Entrepreneurs own businesses. Investors own assets. Rich kids? They own trusts, pieces of wealth someone else built. And athletes, entertainers, and artists? They own rare skills nobody else can just copy. The pattern here is ownership. That's the key. If you don't own anything, you end up being owned. Most people never figure that out. Most systems are designed so you don't. I've spent decades learning how wealth actually works. I've run businesses, taught thousands, and, honestly, I'm still a student when it comes to building real financial freedom. On this channel, Investor Voice, there's no hype. No fairy tales or get-rich-quick nonsense. Just real strategies that work in real life. Tonight, I want to show you a system I've used for years, the 25-15-50-10 rule. I built it so anyone, no matter how much you make, can manage money like the top 1%. Because it's not about your paycheck size, it's what you do with it. Let's jump in. First, take 25% of your income and put it toward growth. This isn't some fluffy self-help talk about personal growth. I'm talking about money that works for you while you sleep. Use it to buy real assets, things that actually go up in value and pay you back, even when you're not paying attention. Here's what most people do. They get paid, pay the bills, and whatever's left, it's gone by next week. A new gadget, a night out, some clothes they'll forget about. By the end of the month, they're back to zero, waiting for the next paycheck and wondering where all the money went. This is why almost everyone ends up with nothing to show for all their work. And look, that's not an accident. The whole system is built to keep you running in circles. It keeps you feeling rich for a few days, then broke for the rest of the month, counting the days until you get paid again. No cushion, no savings, no breathing room. You're stuck working even harder just to stay afloat. It's modern slavery, really. Back in the day, slaves worked all the time for no pay, but they got food and shelter. Now people work non-stop, get paid, but spend almost everything on the same basics: food, rent, water. The only thing that's changed is the illusion. Once you see this for what it is, you can start fighting back. And the way you fight is simple. Take that first 25% and put it straight into assets. Assets are anything that grow in value and put money in your pocket. The goal is for your money to start working for you. If you stick with it, those assets can end up paying you more than your day job ever will. That's when you win. I get it. You're probably thinking, Michael, this all sounds nice, but I barely have enough money to cover my bills. How am I supposed to invest in anything? Trust me, I've been there. I started out with nothing too. But you've got to find a way, because the sooner you start, the bigger the difference it makes. Let me show you why starting early matters so much. Picture two people, Billy and Phil. Billy starts investing $200 a month at age 20. Phil waits until he's 30, but to catch up, he decides to put in $300 a month. They both stop investing when they turn 60. So Billy invests $200 a month for 40 years, which adds up to $96,000 out of his own pocket. Phil puts in $300 a month for 30 years, totaling $108,000. So Phil actually puts in $12,000 more than Billy. You'd think Phil should end up with more, right? That's not how it plays out. Because they're not just saving, they're investing. If you use a 10% annual return, which is around what the S&P 500 has averaged over the long run, the numbers look wild. Phil's account grows to about $678,000, pretty solid. But Billy? He ends up with around $1,264,000. That's almost $600,000 more than Phil, even though Billy invested less of his own money, just because he started 10 years earlier. That's compound growth at work. That's why you need to start now, even if you can only manage a little. Waiting costs you way more than you realize. So how do you actually get started with that 25% growth allocation? First, pick your growth assets. There are tons of ways to grow your money, but they're not all equally risky or rewarding. I think of them as a spectrum, from safer options to bigger gambles. On the safer side, you've got index funds. Honestly, most people should start here. You don't have to pick winning stocks or time the market. Just buy a piece of something like an S&P 500 index fund, let it sit, and let time do the work. It's not flashy, but it works. Then there's real estate. If you have the money, maybe you buy a rental property. If not, there's REITs, real estate investment trusts. It's like buying a slice of a building with a bunch of other people. You get dividends from the rent, and you can buy or sell these shares just like stocks. Somewhere in the middle is learning a new skill. This, honestly, is the fastest way to see a return. Think copywriting, video editing, sales, coding, digital marketing. Anything that actually brings in more income. The best part? No one can take your skills away from you. They're yours for life. Of course, you've got to put in the work to learn them, so it's a bit riskier than index funds or real estate, but the upside is huge. Let's move up the ladder to online businesses, things like dropshipping, selling digital products, launching a YouTube channel, or starting a newsletter. These can really pay off, but they're not easy wins. You have to put in a ton of work, and honestly, you'll probably fail a couple times before you figure out what clicks. Most new businesses flop. That's just how it goes. But if you do make it, the payoff can be life-changing. Next up, individual stocks. I get it. It's tempting to go hunting for the next Tesla or Nvidia before everyone else catches on. But unless you're putting in serious research and you actually know your stuff, you're pretty much just guessing. If you want to pick single stocks without doing a deep dive, keep it small. Treat it like a side project, not your main plan for building wealth. At the top of the risk pyramid, you've got alternative investments. Bitcoin, Ethereum, NFTs, gold, wine, sneakers, rare collectibles, all that stuff. Sure, you can make money here. You can also lose it all overnight. I've dabbled in some of these myself, but I never put in more than I'm willing to see vanish. These are moonshots. Fun to mess around with, but not where you build steady wealth. So, if I were starting out, I'd go for the things that actually give you a strong base. Index funds and building high-income skills. Once you've got those down and you're more confident, then try experimenting with the riskier stuff. Knowing what to invest in is only half the battle. You also need to know how to invest. Because if you're using the wrong kind of account, you could end up paying thousands in unnecessary taxes, and you might not even realize it. That's why the next step is setting up tax-advantaged accounts. Let me walk you through how to save as much as possible on taxes, all above board. Just a quick heads up, I'm not a financial advisor. I'm sharing what I've done and what's worked for me. Always talk things over with a pro who gets your situation. Let's start with the UK, since that's where I am. One of the best options here is the Stocks and Shares ISA. You can put in up to £20,000 a year, and everything you make, whether it's growth or dividends, is totally tax-free. No capital gains tax, no tax on dividends. You can set one up with trading 212, Vanguard, or Hargreaves Lansdowne. Just pick the Stocks and Shares ISA option when you sign up. That's it. If you've got a regular job in the UK, chances are you have access to a workplace pension. Usually you contribute about 5% of your salary, and your employer matches with another 3% or so. That's free money. Your investments grow without being taxed, and it's basically the closest thing to a guaranteed return you'll ever get. Always grab the employer match. If you're in the US, things work a bit differently. The Roth IRA is one of the best accounts out there. You invest money you've already paid tax on, but everything it earns grows tax-free. When you retire, you can withdraw it all without paying a cent in tax. For 2025 and 2026, the limit is $7,000 per year if you're under 50. Even billionaires use Roth IRAs. Peter Thiel, one of PayPal's founders, reportedly turned his into over $5 billion by investing in startups like PayPal and Facebook early on. That's the magic of tax-free growth. There's also the 401k, which is basically the US version of a pension. Money goes in before taxes, so it lowers your taxable income right now. It grows tax-deferred, and if your employer offers a match, take it. That's free money on the table. I get it. not everyone reading this lives in the UK or the US. Your country probably calls these accounts something different, but the core idea doesn't change. Pretty much every developed country offers some kind of tax-advantaged retirement or investment account. Take a bit of time to find out what's available where you live, and then actually use it. Those tax breaks add up more than you'd think, especially over a few decades. Here's where a lot of people mess up. They open the account, put money in every month, and then just leave it sitting there. The cash doesn't do anything. It just sits, not earning a thing. Don't stop there. The next move is to actually invest. Once you've chosen the right growth assets and set up your tax-advantaged account, you're ready to go. It doesn't matter if you're using Trading 212, Vanguard, Fidelity, or something else. It's time to put your money to work. The easiest way? Set up an automatic transfer every month, ideally right after you get paid. That way the money moves straight from your bank into your investment platform and you never get the urge to spend it on something random. When your cash hits your investment account, you don't need to become a day trader or obsess over market charts. Just look for some solid index funds. A 3-fund portfolio works really well for most people. Here's how that breaks down. Your first fund is usually a U.S. stock index fund, something that invests in big American companies like Apple, Microsoft, Amazon, and Nvidia. The second is an international stock index fund, which covers companies outside the U.S., places like Europe, Japan, and Canada. The third is a bond fund. Bonds help balance things out because they're usually less wild than stocks. Let me give you a quick example. For the U.S. stock portion, something like a Vanguard S&P 500 index fund does the trick. It's like owning a slice of 500 major U.S. companies. For the international piece, you might pick the iShares MSCI World UCITS ETF, which scoops up companies from all over the globe. And for bonds, maybe something like the iShares Treasury Bond ETFs, which basically means you're lending money to the U.S. government. Once you've picked your funds, decide how much of your money goes into each one. That's your asset allocation. If you're young and have years ahead, you might go heavy on stocks, like 90% stocks and 10% bonds. That gives you more growth potential, but yeah, the ride's bumpier. If retirement's closer, you might choose something like 60% stocks and 40% bonds for more stability. There's no perfect formula for everyone. It depends on your goals, your timeline, and how much risk you can handle. Once you automate your investing, your job actually gets a lot easier. Stop tinkering and focus on earning more. The people who really build wealth aren't the ones chasing hot stocks or trying to time the market. They're the ones who keep putting money in, month after month, year after year. So, focus on boosting your income. That's where learning new skills or starting a side hustle comes in. Make more money, invest more money, and just keep repeating. All right, moving on to the next part of the 25-15-50-10 rule. That next 15% of your income, it's about stability. This is what keeps you in the game long term. Too many people think every dollar should go toward investments or lifestyle upgrades, but you need a chunk set aside to protect your progress. I really wish someone had drilled that into me when I was younger. Would have saved me some painful lessons. I didn't grow up with much money. My parents never sat me down to explain how emergency funds work or why you need a financial cushion. So when I turned 18 and needed a car to get to work, I didn't have any savings. I did what a lot of people do. I took out a loan. Bought a used Volkswagen Golf, even splurged on a new stereo with the extra cash the bank handed me. For 3 months, I felt unstoppable. Then, just like that, the engine blew up. Total disaster. I had no backup plan, no savings, and honestly, no idea what to do next. If I didn't fix the car, I'd lose my job. So I borrowed more money, which only dug me deeper. More debt, more stress, more pressure. That car didn't just break down, it wrecked my finances, knocked me back an entire year. If I just had even 15% of my pay set aside, things would have been totally different. People don't really have money problems. They have stability problems. One surprise bill, a car repair, medical emergency, losing your job, and suddenly everything falls apart. Even if you're investing, you'd have to sell at the worst possible time, locking in losses just to get by. You need a buffer, a margin for error. So how do you actually build this safety net? First, figure out what you need. List your core expenses: rent or mortgage, groceries, utilities, transportation, insurance, stuff you literally can't go without. Not streaming subscriptions, not takeout, just the essentials. Add those up. That's your monthly baseline. Let's say it comes out to $1,500 a month. Multiply that by 5. That's your target stability fund, in this case $7,500. Every month, take 15% of your paycheck and stash it away until you hit that number. I get it. 5 months of expenses sounds like a lot. It's definitely on the cautious side. But after what I've been through, I know life can turn upside down in a second. You might lose your job and spend months hunting for a new one. You might have a medical crisis, or maybe a family member needs help. 2 months of savings probably won't cut it. Next, you have to store this money the right way. Where you keep your stability fund matters just as much as having it. I always stick to 3 rules. First, quick access. You need to be able to get to this money within 24 hours, no exceptions. Don't lock it away in an account with penalties or waiting periods just for a bit more interest. I've seen people lose their jobs and still not be able to touch their emergency fund because it was tied up somewhere complicated. Makes no sense. When things go wrong, you need cash, fast. Second, zero risk. This is not money to invest, gamble, or chase returns with. Don't put your emergency fund in the stock market, even the safe stuff. If an emergency hits and the market's down 30%, you're stuck. Same goes for crypto, long-term bonds, anything that can lose value. This money just needs to be there, always. Third, it should earn something. This isn't your growth fund, but don't leave it sitting in a zero-interest account. Park it somewhere that pays a little but with no risk. High-yield savings accounts are perfect for this. Right now you can get 4 to 5% interest, no penalties for withdrawals. That's enough to keep up with inflation and protect your spending power. Step 3. Stack your stability fund fast. People act like it takes years to build a decent emergency stash, but that's just not true if you play your cards right. When I started building my own savings, I used 3 tricks. Each one made the other work even better. First up, the paycheck sweep. The second your paycheck hits, pull out 15% and send it straight to your emergency fund. Don't even think about it. Set up an automatic transfer or direct debit so it happens on its own, just like we did with the 25% for growth. Set it and forget it. Next comes the replacement promise. This is a deal you make with yourself. If you ever need to dip into your emergency fund for a real crisis, you refill it right away. Say your car suddenly needs $500 in repairs. That's what the fund's for, so use it. But as soon as you get paid again, put that $500 right back, so your safety net stays solid. Then there's the save by spending trick. Sounds weird, but it works. Use one of those roundup apps that scoops up your spare change. Every time you buy something, it rounds the amount up to the next dollar and drops the difference into your savings. Buy a coffee for $3.60? That 40 cents slides into your fund without you even noticing. It adds up faster than you'd expect. Or use a cashback credit card, pay it off in full every month, and throw every reward dollar straight into your emergency savings. Once your stability fund is fully stocked, you've got a choice. You can push that 15% into your growth fund or roll it into the last 10%. I'll get to that in a bit. Now let's talk about the next part of the rule. Half your income, 50%, should cover your essentials. This is the stuff that actually keeps you going, not the stuff that just looks good on Instagram. Here's the wild part. Over 60% of Americans who make $100,000 or more still live paycheck to paycheck. Seriously. 6-figure earners, and they're still broke at the end of the month. Why? They're so focused on looking rich, fancy cars, designer brands, huge houses, expensive dinners, that there's nothing left when the dust settles. I've seen it up close. Back when I was 20, I had a friend who looked like he had it all. Designer shirt, shiny watch, always out spending. I was the opposite. Baggy shirt, cheap watch, just the basics. Not exactly a style icon, I'll admit, but I was young. Don't judge me. What people didn't see was the truth. He had $43.20 in his bank account, plus overdue credit card bills. I, on the other hand, had more than $1,000 tucked away in investments and a solid emergency fund. I'd learned my lesson from a messy car loan and clawed my way back, cutting every extra expense, even if it meant looking a bit rough. $1,000 might not sound like much now, but back then that was real money. And that's the part people miss. Wealth isn't about what you show off, it's about what you keep hidden. It's the quiet savings, the investments growing in the background, the emergency fund that lets you sleep at night. Not the flashy stuff. I get it. Lifestyle creep sneaks up on you. It's easy to say, I need a safer car, or this new house is closer to work, or I've earned a nice meal out. But that's exactly how it starts. Little upgrades, one after another, until you find yourself spending 70% of your paycheck on essentials that, let's be honest, aren't really essential at all. So how do you stop it? First, get brutally honest about what's truly essential. Most people won't love this part because a lot of what we call essentials are really just luxuries in disguise. Essentials are things that keep you alive and functioning: rent or mortgage, groceries, utilities, basic transportation, insurance, and the clothes you actually need to get by. Not designer clothes, not the latest gadgets, just what you have to have. Now, here's what doesn't count. Takeout, that Amazon subscription you completely forgot about, the gym membership gathering dust since January, all those streaming services you keep meaning to cancel. The list is longer than you think. If you genuinely use the gym every week, sure, keep it. But so many people sign up for things they never touch. One of the easiest ways to claw back extra cash is to pull up your bank statement and cancel anything you're not actually using. If it's not helping you live, work, or stay healthy, it probably shouldn't be eating up your essentials budget. Why cap essentials at 50%? Because most people already spend 60 to 70% of their income on what they think are essentials. Cutting it to 50% forces you to trim the fat. It also flips your mindset. Instead of looking for new ways to spend, you start thinking about how to earn more, which, honestly, is something you should always be working on. Next, focus on the two biggest money drains: housing and transportation. That's where your dollars really disappear and where you can make the biggest changes. Let's start with housing. For most people, it's the biggest bill each month, but it doesn't have to go up every time you get a raise. Always try to renegotiate your rent when your lease is up. Most landlords would rather keep a steady tenant than deal with finding a new one. Even a small rent freeze or reduction adds up fast. If you want to go further, try house hacking. Rent out a spare room, split your place with roommates, or, if you can stand it, move back in with your parents for a while to build your savings. If you can keep housing under half your essentials budget, you're in a solid spot. Now, transportation. Car payments are wealth killers. People lease shiny new cars for the status, but end up stuck with payments on something that loses value every month. That's why I always say, buy a used, reliable car that's already done most of its depreciating. Do that until you're earning enough that a nicer car barely dents your budget. And by barely, I mean it should be way under half your essentials fund, not something you're just squeezing in. If you live in a walkable city or somewhere with solid public transit, think about ditching your car altogether. Seriously, the savings add up fast. Not just the monthly payment, but insurance, maintenance, gas, and parking too. Suddenly, you're holding on to hundreds of extra dollars every month.